This chart shows a clear uptrend channel in the market. Price is moving upward between two diagonal lines, the support line below and the resistance line above. Each time price pulls back, it finds support at the lower line and then moves higher again, creating higher lows. When price rises, it reaches the upper line and forms higher highs, showing strong buying pressure. This repeated pattern of higher highs and higher lows confirms that the overall trend is bullish. As long as price stays within this channel, buyers remain in control and the market is likely to continue moving upward until a clear break of support or resistance occurs.
How a trend channel is built step by step in an uptrending market. First, the important swing highs and swing lows are identified, showing where price clearly changes direction. Next, a main trend line is drawn by connecting the higher swing lows, which represents the market's underlying bullish direction. After that, a parallel channel line is copied and placed on the swing highs to create a complete price channel. Once the channel is formed, price is seen moving smoothly between the lower trend line and the upper parallel line. Pullbacks tend to respect the lower boundary, while rallies move toward the upper boundary, confirming controlled bullish momentum. As long as price stays inside this channel, the trend remains strong and structured, helping traders anticipate support, resistance, and potential continuation points.
How a trend channel can be used for clear buy and sell decisions. The lower blue dashed line represents support, while the upper red dashed line represents resistance. When price moves down toward the support line and shows signs of rejection, it creates buy entry opportunities as buyers step in and push the price higher. On the other hand, when price rallies up to the resistance line, it often slows down or reverses, creating sell entry opportunities as sellers take control. The repeated movement between these two boundaries shows a well-respected channel where price action remains structured and predictable. As long as price stays within the channel, traders can focus on buying near support and selling near resistance, following the overall upward trend smoothly and consistently. How to place stop loss and take profit levels when trading inside an uptrend channel using proper risk-to-reward management. The buy entry is taking near the support line, where price shows bullish rejection and follows the overall trend. The stop loss is placed slightly below the support level to protect against a trend breakdown, which defines the risk, shown as 1 unit of risk or 1R. From the entry point, 2 take-profit targets are set near the resistance area. The first target offers a 1-to-2 risk-to-reward ratio, meaning the reward is twice the risk, while the second target offers a 1-to-3 risk-to-reward ratio, where the reward is 3 times the risk. This approach allows traders to control losses, let profits run with the trend, and maintain consistency over time by ensuring rewards are always greater than the risk taken. Compares a valid trend channel breakout with a fake breakout, helping traders understand the difference clearly. On the left side, a valid breakout is shown where price breaks above the channel with strong momentum and a sustained rally. Candles close firmly above the channel, volume increases, and price continues moving in the breakout direction, confirming that buyers are in control. This type of breakout usually leads to continuation and offers reliable trading opportunities. On the right side, a fake breakout is shown, which acts as a trap. Price briefly spikes above the channel but quickly loses strength and gets rejected. Instead of continuing higher, it falls back inside the channel, trapping traders who entered too early. This false move is often followed by a reversal or deeper pullback. The key lesson is to wait for confirmation, such as strong candle closes and follow-through, rather than reacting to a single spike, to avoid getting caught in fake breakouts. A complete trading strategy using a trend channel combined with moving averages and RSI for confirmation. Price is moving inside an upward trend channel, which defines the overall market direction. When the moving averages are sloping upward, the trend is bullish and buy opportunities are preferred. A sell confirmation appears near the upper channel when price becomes overbought and the faster moving average crosses below the slower one, signaling short-term weakness. On the other side, a buy confirmation forms near the lower channel when price is oversold,
RSI drops below 30 and then turns upward, and the faster-moving average crosses back above the slower one. This alignment of trend direction, moving average cross, and RSI condition helps filter out weak signals. By combining these tools, traders can time entries more accurately, trade in the direction of the dominant trend, and avoid emotional or low-probability trades, making the strategy smoother, safer, and more consistent for real trading.
This final example shows the full trading process, from analysis and setup to execution and result, using a trend channel breakout strategy. In the first part, price is moving inside a downward trend channel, and a clear plan is prepared before entering the trade. The entry is placed near the lower boundary after signs of reversal. The stop loss is set below the recent low to control risk, and the take profit is positioned near the opposite side of the channel, offering a strong risk-to-reward ratio. In the second part, price breaks out of the channel with strong momentum and moves upward exactly as planned. The trade reaches the take profit level, resulting in a successful move of around 130 pips in profit. This example highlights the importance of planning before execution, following structure, and letting price reach predefined targets without emotional decisions, which is key to consistent and disciplined trading.